Understanding PTET for multi-state businesses. The pass-through entity tax, PTET, applies to businesses like SM LLCs, partnerships, and S corporations, which are legally considered the same as the individual who owns it. The tax was designed to bypass the state and local tax, SALT, deduction limit cap. It provides a great tax planning opportunity for pass-through business structures. Remember that when a pass-through business entity makes a profit, profit flows through the business and onto the owner's tax return. So the owners report the profit to the IRS instead of the business itself. PTET is the state entity level income taxation on the relevant businesses. At the moment, 36 states have elected it, each with its own way of calculating the tax. Some have even made the tax mandatory. You can find more details about state-specific considerations on our blog. Still, PTET essentially boils down to the amount you'd pay at individual level if your income was passed through. The goal is to reduce your business's ordinary income by the amount of tax paid. Owners, partners, members, or shareholders will have lower federal income and won't pay state taxes on business income. Instead, you'll get a refundable credit on your state personal income tax, or you can subtract business income by your normal state income. A state imposes a tax rate on income derived within its borders. But under PTET, this is paid through your company's tax return. Therefore, a credit is listed on your partner or shareholder's K1 to offset the tax earned at the individual level. But how much are you saving exactly? As an individual taxpayer, you will save the amount of credit multiplied by your federal tax rate. So what about multi-state businesses? If your company operates in a single state, PTET procedures and calculations are pretty straightforward. The challenge comes in for companies operating in multiple states, especially if the owners reside in different states. After all, these jurisdictions generally use federal taxable income as a starting point and adjust this based on individual state tax rules. But if those rules differ, so will the adjustments. And some states differ on exactly what income is subject to PTET. To make this even more complicated, states like New York give you a refund for the credit, while other states like California only let your business carry the credit forward to the next tax year. This all means that a proactive strategy is essential. That includes keeping up to date with any changes and having detailed and accurate records. And as always, when in doubt, consult a pro. At Fusion CPA, our expert team can help you navigate PTET with ease. We're just a call away.